Welcome, everyone. My guest today is Lead Analyst Logan Mohtashami to talk about the market's response to all the trade war news over the last week. Logan, welcome back to the podcast.
Wow, Sarah. It seems like a lot has happened since the last time we talked. And so the last podcast we did, for everyone listening, we did it Friday morning, and the only news that was circulating was that possible 1 month delay in tariffs. And that's why we talked about maybe Trump has to do something so people won't call his bluff. And then 15 minutes after the podcast was over, we get the news from the White House that they're going in. And all hell broke loose over the weekend. Of course, some of the trade war tap dance got resolved for the next 30 days. But wow, what a crazy few days and nights.
Truthfully, I mean, I feel like between Friday night, Saturday morning, Sunday afternoon, there was news on the tariffs all weekend long. And one thing that kept striking me is that you were right when it came to you're like, listen, we don't need to take, even though he's serious about maybe proving that he's going to do something, this is all just negotiating tactics. So since that time, we've seen him, oh, okay, we're extending it for a month. Oh, okay, we're doing this now. And so it feels like that's the exact right take, which was, it's not that there won't be some short-term pain on these, but he's just using it to as a negotiation tactic.
Okay, so let's kind of review 25% tariffs to our biggest trading partners. The leverage we have over Canada and Mexico is easy because they sell us so much to their economies that matter more. I think for Mexico, it'd be like negative 8% GDP, and in Canada, it'd be negative 5% for us. Like if this was on for a full year, it'd be like negative 1%. But what was the market reaction? Right off the bat, dollar got stronger, like we've always talked about. This is always going to be about a currency issue, and the dollar got stronger, which defeats the whole purpose of trying to export stuff. Originally, the 10-year yield shot up on the news. Stock futures were down. Oil prices were up. Lumber prices were up. Okay, and then what did we see? We saw the National Association of Home Builders pleading their case on not getting tariffs from Canada. And remember, Canada's got that soft lumber that we like. We don't have enough sawmills and things in place to, produce our own anytime soon. So when Trump says short-term pain, he's not kidding about that. For us to change universally something like that, it would take time. But that was the response. And then, shocking enough, a wire came out that he's going to talk to the president of Canada and Mexico, and 10-year yield went down right away. Now, the markets were still down. The dollar still stayed elevated, but the bond yields just fell right away, kind of saying, okay, this is going to get resolved. And then in Monday, you saw the stock market fall initially. Then when all the presentations were made or news came out, markets rebounded. And we're here. And now it's Tuesday morning. We're talking about China. China just did their tariffs against our chip companies, Intel, NVIDIA, and everything. And I could see a big fight happening with the EU in that regards. But now this went straight, almost nuclear right away. Everyone got to see how it's operated. This is similar to somewhat what we talked about in 2018 and 19, except that was a much smaller base of imports. And just to give everyone an idea, if I had my charts with me, the PCE inflation didn't really take off when there was a trade war tap dance back then. But if I took the subcomponents of things that were tariff, those prices did rise. It's just that the scale of the inflation data, all the components into it didn't. And that's why you saw back then things that were hit with the tariffs, their prices did increase, everything else didn't. And that's how, inflation didn't really take off during the trade war tap dance in 2018-19.
I think that's one of the most interesting parts of this to me is we were talking about on Friday, we didn't know what will mortgage rates do in response to this, right? Where are we going to end up? And where we ended up was, yes, there was a little bit of change, but basically flat.
Yeah, mortgage rates have not been moving at all. It's the irony. This whole drama, mortgage rates have pretty much been flat for the 6 or 7 trading days. This morning, the job openings data came in. Job openings decreased. And the quits and hires are still low compared to what it was in the previous few years. So the labor market's getting softer. And how we've always highlighted this is that the big job growth came in government, in healthcare last year. Manufacturing jobs lost. Manufacturing actually had a good report. Maybe some of that was front loading on the tariff deal, but GDP came out yesterday, 3.9% for Q4. But what's interesting is that everyone got to see the market reaction. Unless you were like a normal person and didn't see how commodities were trading on a Sunday night. But in me, I was just like, oh God, look at this. This is what so I think everyone gets to see what it would be. Right? We've got a first taste. Now, this is our biggest trading partners, right? That's why it was a big deal. Realistically, Canada cannot and Mexico cannot handle. Now you could say their currencies would depreciate and the pain would be less, but that's why you had that initial drama and everything gets solved. To me, it's always the simple premise that I've had since 2016. If you authentically wanted tariffs, you literally just put them in place and there's no negotiation, because you need years and years of behavioral changes by companies. And there's going to be years and years of trying to handle the tariffs that are being retaliated. This is why I don't believe in the tariff premise back then or even now. But I think it was good for everyone to kind of visually see. And now even President Trump talks about, there's going to be short-term pain and all this. But this is just how it's going to be. So we're going to have to get used to 4 years of drama. And I'm sure with Elon Musk, there will be more drama coming up ahead, and we'll just try to make sense of the economic side of it every single day. We had a blitz of people coming to the Instagram page, finding out what was happening on Sunday night trading. So I think it's good. People get to be informed of how currencies and commodities and how companies look at this. And you can see the builders were just begging for, hey, let's not get into this.
Well, I mean, this is not what the housing market needs. I mean, let's just be honest. We do not need, rising prices on lumber and all of the metals that go into making a home, anything like that. I mean, affordability is already, we're in a crisis for housing affordability. The president knows that. He acknowledged it his first day. So it seemed very, counter to that message to be like, hey, home builders, we're going to hit you with 25%.
Here's one thing the first thing that came to my mind when I saw the builders letter. So what did we write was the wild card for 2025 was the home builder sector. Why? Because when you think of this, think of it as a business. Don't think about the economics. The two things we highlighted that were the risk were supply increasing and margins. So if rates stay elevated and then you get hit on the tariff side, margins get hit. There are more risk to labor. So that was a front line, I give a little mini dissertation on Twitter on supply, and now margins getting hit harder makes it more problematic for the builders. That's why you saw that letter go out on Friday about asking for the tariffs not to happen with lumber. So if you think about it in that light, that, they're already kind of, inventory is picking up. There's margin hits now. The gross profit margins for the builders are still elevated compared to the previous decade. Not so much. It's a little bit lower, but you could see why they had that concern. Again, that's the wild card, because if you lost manufacturing in 2024, if you lose the residential construction workers, and then also because so many people working in that are remodeling costs go up, then that becomes a problem in that sector. The labor gets hit. Right. And then that's the trigger for every recession we've seen in recent modern day history. That's why I always highlight that chart for everyone. So visually, it's such an easy chart to visually see because it's such a clear, transparent trend. We have not had that go negative. But when you have manufacturing, this happen. And then if Elon Musk fires a bunch of workers, federal workers, jobless claims start to pick up. There's your, labor data gets weaker. Then the Fed has to, unemployment rate at 4.3%. It's above that. Bond yields should go down in that environment. But again, all that was averted. So we wait for the next one. We still have China. We still have The EU, China thinks they have February 12th is their date that they implemented. So a lot of talking. And we'll take it one day at a time. And we're here 24/7 for all of this.
You are, you are. Okay, so that brings us to the next topic, which is kind of got overshadowed starting on Friday, which, with the inflation story, with the tariff story, and that is, it is jobs week. So you have always
It's
said
jobs
this
week,
is the
and
most important thing.
and again, when the job openings data came out, the 10-year yield fell a little bit. We're kind of in a very tight range right about now. So again, to me, the labor data is always the most critical, because if labor data was breaking, everything changes, right? Because unemployment rates rising becomes problematic for the Fed to stay restrictive, because the Fed's own model, they will tell you they're restrictive because the Fed funds rate is here, the growth rate of inflation is here. It's funny, the New York Fed's multi-core inflation data that the Fed loved to talk about, all 2.3%, another two handle. Here we go again. And look, we still have 7% mortgage rates. That's why paper, rock, scissors. Labor over inflation. We just gave a presentation to the state of Ohio, and they're like, "Oh wow, it really is labor." And in this regard, jobless claims, job openings, BLS jobs, rather, the ADP report isn't as important, but keep an eye on wage growth. Wage growth was decelerating, kind of firmed up a little bit. I think that's something to keep an eye on Friday. But we saw bond yields just ticked down a few basis points after the job openings report.
So interesting. If you're in the Fed and you're seeing all these things happen, I mean, you talk about wild card. You've got all these other things you've got to now take into account, right? That maybe under a Biden administration, much more less exciting. We'll say that less exciting things going on most of the time.
Don't call him Sleepy Joe for nothing.
Despite that, of course, we had that incredible 2022 mortgage rate skyrocketing, Fed funds rate skyrocketing. But still, I would just think that this is a really interesting time to be in the Fed, and then trying to figure out, like, how do you balance everything right now when you have some wild cards.
So this is their stance of right now. The Fed has publicly said they will look through one-time price adjustments. Okay, so they're not going to react to one-time price adjustments. But if inflation persists higher for longer, then it's going to, make their cloudy skies in terms of judgment on what to do in the future. So this was actually a very interesting topic on Twitter from financial people. Like, what level of inflation will the Fed just say, listen, we're not cutting anymore if there's no labor data getting weaker? I kind of said in that conversation, if core PCE, which is running at two handles, by the way, but if core PCE was running between 3.2 to 4.2%, they're not cutting, right? Because we've already made the progress we've done with the PCE inflation. If you get back up there, then that's something else. But again, the items that were tariffed in 2019, those prices increased, but the general economy did not see that in kind of inflation. So it really is, and it's another thing where people are more talking that companies feel like they can, pass on the prices to the consumers, and some companies don't. So it's just a lot of new variables in this that they're looking at. But as of right now, their kind of stance is they're going to look through one-time price adjustments, but if it persists higher, then they'll change. But the labor market breaks, that all goes away.
I wouldn't think that you would expect a big break this week in any of the jobs data, right? Like, yes, continuing the trend of it getting softer, but you don't expect it to be a big deal on Friday, right?
So as I've often talked about, every year there's 3 reports that are really bad, and there's 3 reports that are better than expectations. So it's one of these things where everyone tends to overreact on the bigger or weaker data. It's the trend that matters. And to me, the trend is getting softer, but the trend is basically at my level. If we are running, payrolls under 108,000, the unemployment rate is going to tick up. And because of that, the Fed gets to their okay, we don't want this to get any worse. The 10-year yield goes lower for that. So you can have a missed report and the bond market react, but a missed report is lower wage growth slowing down because they're at the limits of where they would feel comfortable with the unemployment rate. So that's why I say they kept that unemployment rate target low just in case if anything happens, they want to get ahead of that early on. And they've got a sector that is still in a recession, and that gets impacted in a positive way with lower bond yields and lower rates. So we'll see what happens on jobs Friday. But so far, job openings came out, a little bit lower. Bond yields fell a little bit lower. But again, we're still at 7% rates. If the mortgage rates are just down to 6%, housing changes. We've seen that now for 2 years. And every year that goes by, wages grow. Household formation. Like I always talk about at this event, I said, you get closer to death, Sarah, every day. So people have to make choices, right? And everything runs around the 10-year yield. The spreads are better this year, of course. That's a huge important. We're not talking about 8% mortgage rates, but 7%. Spreads get normal. We're talking about 6% mortgage rates, changes the variable. Spreads get normal with lower 10-year yields. Oh, boy. Then you start getting into the builders grew the sales back to 2019 levels. Can the existing home sales market get back? And like I said, I don't love the pent-up demand thesis, but because sales have been depressed at the lowest levels ever when you adjust it to the workforce for this period of time, it doesn't take much to move the needle. And I urge everyone, go back to the 1980s. 1980s, affordability was worse. There was a recession. No, everybody said, nobody's going to buy homes. We're a renter nation. It was a vertical rebound in demand. That's why I show those 1980 existing home sale charts. It back then was much worse than what we're dealing with today. And still, sales went up.
Well, let me ask you about another variable. Probably doesn't show up in the mortgage rates or bond yields, but you're a former LO. Your dad still in the business, right? Tons of people in this industry. The CFPB being basically shut down. What is your reaction to that?
Well, the thing is, when you shut the CFPB down, you're going to have to tell people what that really means. Is everything still in place and just the entity is shut down? Okay, so if that's the case, then business as usual, and you're not getting new enforcement. Okay, so if that's my first and only view on this until there's more clarity. So if that's the case, everybody sticks to the original regulations that are still in place, and there's nothing new coming on. That's the best way to look at it at this point.
This is what we're trying to get clarity on, right? From the newsroom, they're trying to be like, okay, what does that mean? And yes, definitely you can see there's nothing new happening, but it's not even clear, if the CFPB, obviously it was created by the Dodd-Frank Act, and so many of the things that the industry now does that are industry practice are from that Dodd-Frank Act.
You still do all those things. You still do all those things. Just for right now, there's going to be no other enforcement. Anything that was in the works is done, but you still run off the old rules. That's the best way to look at it. Until they tell you otherwise, you just stick to the olds. Trade is still here. Everything, all that process is still in here. But anything new is done. I don't imagine them reopening the CFPB for the next 4 years.
Yeah, no, I agree with you. How that actually happens, because we're looking at the legality of can the director shut it down like that because it was created by Congress? The funding is through different, it's a lot of questions right now when you think about some of the actions being taken, how things are funded, and who has the authority to do what.
That all gets settled in Congress and courts and everything, but until then, it's the CFPB is. I put a comment. I put a picture of the Undertaker, the wrestler, and just said the CFPB is over. So just go with the old rules and don't think you can change anything. But until there's more clarity, just everything as is, and there's nothing more coming on the regulation side. Now, now an interesting aspect on top of that is, does the new Department of Justice just throw in the towel on the NAR, prosecution. Okay,
Yes.
so I think this is something a little bit more interesting in the sense that the reality is that the Department of Justice, the old Department of Justice, wants the NAR to make a rule saying the sellers can't pay ever. And just keep it clear. And NAR is like, no. And home sellers will be like, well, no, we want that choice. The Department of Justice can't, I don't think, legally get that on their side to do it. So the question is, if that's the next move, that the new Department of Justice says, okay, we're not asking for any of this and let's just move on. That's another thing to think about in the next few weeks. So it's just, this whole party is just starting. So everybody just kind of get used to it, and I'll track it as best as I can 24/7.
And I would encourage people, look at the tracker every weekend. You're looking at all this data, really fresh data on like 8 or 9 different points every week, and looking at the trends. I think that's really important too. And then, of course, our economic summit coming up now, just like 3 weeks from now, February 26th in Dallas, Housing Economic Summit. A whole bunch of smart people talking about every part of what's happening in the industry.
Yeah, it should be a lot of fun, and I think it's always benefit if you could have multiple people talking one day. It's really rare to get something like that happening, but if you have different viewpoints, different economists, different analysts, and even on the spectrum of mortgage, political, all that side, it's very beneficial.
Love it. Logan, thanks for keeping us up to date, especially with all the work this weekend on tariffs on, tariffs off, what it all means. So appreciate you.
Yes, and we had a blast here in Ohio. It looks like I'll be back here a few times this year. They love the presentation. And next is Boise. Yes, Boise. First time in Boise. So I'm having the time of my life on the Nerd Tour.
You're covering the country with these talks. Yes. It's awesome. Logan, we'll talk again soon. Thank you so much.
Pleasure.